Imagine you worked hard your entire life, saved diligently, did everything right, and then woke up one morning to find out that doing everything right was actually the wrong move. That is not a hypothetical. That is what happened to millions of Americans between 2020 and 2024. People who saved, people who played it safe, people who kept their money in a savings account because that is what responsible adults are supposed to do. They lost, quietly, invisibly, without a single headline screaming about it. And the people who borrowed money, spent aggressively, and loaded up on assets they could barely afford, a lot of them came out ahead. This is not a story of luck. This is a story about how inflation rewrites the rules of wealth and how most people never get the memo until it is already too late. Let's go back to basics for a second, because the word inflation gets thrown around so much that it has almost lost its meaning. Inflation is not just prices going up. That is the surface, the headline, the thing they show you on the news when eggs cost $4. At its core, inflation is the erosion of purchasing power. It is a slow, quiet tax on money itself. Every dollar you hold loses a little of what it can buy. Not dramatically, not overnight, just a little, every single year, without stopping. In 2021, U.S. inflation hit 7%. In 2022, it peaked at 9.1%. That was the highest rate in 40 years, and for a brief, uncomfortable window, it forced a lot of people to confront something they had never really thought about. Money sitting still is money moving backward.
Here is the part that takes a minute to really land. Say you have $100,000 sitting in a regular savings account. A year goes by. Inflation runs at 8%. Your account still says $100,000. Nothing happened to your money, right? Wrong. That same $100,000 now buys what $82,000 used to. You did not lose $18,000 on paper, but in the real world, in terms of what you can actually do with that money, you are $18,000 poorer. That is not a metaphor. That is arithmetic. And this is exactly what happened to tens of millions of American savers between 2021 and 2023. The Federal Reserve was paying next to nothing on savings accounts. Inflation was running hot. The gap between those two numbers, the difference between what your money earned and what inflation cost you, was silently eating into the real value of everything people had saved. Economists call this the real interest rate. It is the nominal interest rate minus inflation. And for most of that period, the real interest rate in the United States was deeply, stubbornly negative. You were being paid to lend your money to a bank, except after inflation, you were actually paying them. Most people had no idea.
Now, here is where the story gets interesting. Because inflation does not just punish savers, it reshuffles the entire deck. Think about debt. Most people are conditioned to think of debt as bad. Borrow money, owe money, pay interest, regret everything. That is the standard narrative. And in a low inflation or deflationary environment, that narrative holds. But in a high inflation environment, something strange happens. Debt gets cheaper in real terms. Say you took out a mortgage in 2019, a fixed-rate mortgage, 30 years at 4%. You owe $400,000. Then inflation hits 8%. Wages eventually start rising, home prices go up, the cost of everything around you increases. But your mortgage payment? It stays exactly the same, fixed, locked in. The number on the paper does not move. What changed is what that number means. The $400,000 you borrowed was worth $400,000 when you borrowed it, but $400,000 in 2023 buys significantly less than it did in 2019, which means, in real purchasing power terms, your debt shrank. You borrowed heavy money. You are repaying it with lighter money. This is why throughout history, inflation has consistently transferred wealth from creditors to debtors. The people who lend money lose. The people who borrow money, under the right conditions, quietly win. And the largest debtor in the United States? The federal government, carrying over $30 trillion in debt, running deficits every single year. Think about that for a moment.
But debt is just one piece, because the real story of inflation and wealth is about assets. Not just any assets, the specific category of assets that inflation tends to turbocharge. Real estate is the obvious one. When inflation rises, the cost of building new homes goes up. Labor costs more. Materials cost more. That puts a floor under existing home prices. And when the Federal Reserve eventually responds to inflation by raising interest rates, as it did aggressively in 2022 and 2023, new buyers get priced out of the market. Demand compresses. But the people who already own homes, the people who got in before the rate hikes, they're sitting on an asset that the market can no longer easily replace. Their wealth did not grow because they did anything clever. It grew because inflation restructured the playing field around them. Then there's the stock market. More specifically, the category of companies that have what economists call pricing power, the ability to raise their own prices when inflation rises without losing customers. Apple can charge more for an iPhone and people will pay it. A regional dry cleaner probably cannot raise prices 15% without losing half their clients. The companies with pricing power protect their margins. They pass inflation downstream onto the consumer. Their stock holds up. The companies without pricing power, squeezed between rising input costs and customers who will not accept higher prices, get crushed. Inflation sorts them brutally.
Now, let us pull back and look at the bigger picture. Because what we've been describing so far is not just an economic phenomenon, it is a mechanism for concentrating wealth. Here's the uncomfortable math. People who already own assets, real estate, stocks, businesses, commodities, they get a natural inflation hedge built into their net worth. The value of what they own rises, sometimes dramatically, as the dollar weakens. People who have most of their wealth in cash, wages, or fixed income instruments like bonds or traditional savings accounts, they bear the brunt. The divide between those two groups is not random. It tracks almost perfectly with existing wealth. In 2022, the Federal Reserve published data showing that the top 10% of American households by wealth owned roughly 89% of all stocks. The bottom 50% owned about 1%. When the market ran up during the inflation era, fueled partly by asset price inflation, that gain was not distributed evenly. It was concentrated at the top. The people who already had assets accumulated more of them. The people who did not watched inflation eat their savings while the assets they couldn't afford to buy kept rising. This is not conspiracy. It is mechanics. It's just how the system responds to inflation when wealth is distributed the way it is in America. And it raises a question that nobody in power seems particularly eager to answer. When the Federal Reserve fights inflation by raising interest rates, who actually pays the price?
The Fed's tool is blunt. Raise rates, make borrowing more expensive, cool demand, slow the economy down enough that prices stop climbing so fast. In theory, clean. In practice, complicated. When interest rates rise, mortgage rates rise. The average 30-year fixed mortgage went from roughly 3% in early 2022 to over 7% by late 2023. That is not a small change. That is the difference between a monthly payment being affordable and being impossible for a median income household. New buyers got locked out. The housing market froze. Existing homeowners sitting on 3% mortgages were not selling. Why would they? If they sold, they would have to buy back in at 7%. So inventory stayed low, prices stayed high, and the wealth gap between people who owned homes and people who did not, that gap widened further. The people the Fed was theoretically trying to protect from inflation, working Americans, families trying to buy their first home, people renting while waiting for the market to settle, they paid the steepest price for the cure. The inflation burned them, and then the treatment burned them again. Meanwhile, the people with existing assets, locked-in low-rate mortgages, diversified portfolios, significant net worth, they absorbed the rate hikes with relative comfort. Their 401ks took a hit for a while, stocks pulled back, but they had cushion, they had time, they had the luxury of waiting. Most Americans do not. There is a quieter version of this story that does get told enough. The story of what inflation does over decades, not years. Between 1980 and 2024, the U.S. dollar lost approximately 74% of its purchasing power, meaning a dollar in 1980 buys roughly 26 cents today. Over that same period, the S&P 500 returned, on average, roughly 10 to 11% annually. Real estate in major U.S. metro areas appreciated at rates well above inflation. The assets appreciated. The currency eroded. So there were essentially two Americas running in parallel. One where people stored their wealth in assets that outpaced inflation, and one where people stored their wealth in the currency itself, in savings accounts, in bonds, in fixed pensions, and slowly had that wealth siphoned away. The crazy part is that neither group did anything illegal. Neither group cheated. Both groups were playing by the rules, but the rules were written in a way that rewarded one approach and quietly penalized the other. Nobody mailed you a notice. Nobody announced it. The redistribution just happened, 1 percentage point at a time, compounding silently over decades.
So where does that leave us right now? Inflation has pulled back from its 2022 peaks. The Fed raised rates aggressively and the headline numbers came down. By late 2024, inflation was running closer to 3%, not the 2% target, but far below the 9% high. But the prices that spiked during the inflation surge did not come back down. Groceries did not get cheaper. Rent did not fall. The reset happened on the rate of increase, not on the levels themselves. So for everyday Americans, the damage was already done. And here is what makes the next chapter uncertain. The Federal Reserve eventually has to start cutting rates. The economy slows. The job market softens. The political pressure builds. And when rates come back down, the same dynamics that inflated asset prices before will begin to reassert themselves. The people with assets will ride the next wave. The people waiting on the sidelines will watch prices rise again and wonder when the window opens for them. This cycle is not new. It has been running for decades. What changed recently is that it ran fast enough, loud enough, and hurt visibly enough that people could no longer ignore it.
Here is the thing nobody wants to say plainly. The modern financial system is not neutral with respect to inflation. It does not hit everyone equally. It is not a force of nature that lands randomly on whoever happens to be in its path. It has mechanics. Those mechanics have winners and losers, and the winners are, with remarkable consistency, the people who were already ahead. That does not mean the game is fixed in some conspiratorial sense. It means the rules were written for a world where most people owned assets, and they were never meaningfully rewritten when that stopped being true. The median American household net worth is around $100,000. Roughly 35% of that for most households is home equity. A significant chunk of the rest is in retirement accounts that cannot be touched without penalty. Liquid, deployable capital that can be repositioned in response to inflation, that is a luxury that belongs to a relatively small slice of the population. So, when the next inflationary period arrives, and it will, because they always do, the people with the knowledge and the capital to respond will respond. They will move money into real assets. They will lock in debt at favorable rates. They will position ahead of the curve. And the people without that capital, without that flexibility, without that knowledge, will absorb the cost.
The most dangerous thing about inflation is not that it is painful in the short term. Pain is manageable. You can see it. You can respond to it. The most dangerous thing is that its biggest effects are invisible until they are irreversible. Your savings account still says the same number it said 3 years ago. The balance has not changed. Nothing has been taken, except 30% of what that number meant is gone, quietly, legally, permanently. And somewhere, somebody who understood that this was coming bought an asset, locked in a loan, and quietly absorbed the value that drained out of your account. Not because they stole it, because they understood the rules of a game that most people do not know they are playing. The question is not whether inflation is coming back. The question is which side of it you will be on when it does. That is not a rhetorical question, and it does not have a comfortable answer.